saying is that you have to classify stocks based on the market cap. And like I said in the first aspect of this stock investment masterclass, we have three market capitalization, three ranges of market capitalization. Basically, the small cap stocks, we have the mid cap stocks, we have the large cap stocks, and various exchanges have their own definition of what small cap, mid cap, and large cap should be. So you have to understand the one for a particular exchange, right? In some exchanges, basically, small cap is anything lower than 1 billion, anything lower than 1 billion USD. Mid cap is anything between 1 to 5 billion USD, and the large cap is anything above 5 billion USD is a large cap stock, right? And under the book value, what you're basically looking at are you are focusing on the small cap stocks, like I said, because these ones have the growth for the potential for growth. These ones have the potential for growth, so you have to look at the small cap stocks. Very, very important. And you see, you always hear me, I think I've mentioned it like 3 or 4 times now, potential for growth, because this is basically how you make a lot from the stock market. See, those that invest in stocks, okay, you might want to invest in your growth stocks, and like see that those ones are basically sticking around 10-12% a year. But when you look at likes of value investing, you can go as high as 20-30%. Right? So, and I know this is what people want to get. Nobody wants to find themselves below the inflation rate of the economy, poor. Right? So this is why you have to look for those stocks that can give you a great growth potential, and the small cap stocks are stocks that can offer that. Finally, we're going to look at in terms of the progressive growth. One thing you should consider when you're looking at the progressive growth of a stock is basically its price to book value ratio. That's what I talked about earlier, and then in combination with the return on equity. Right, and to do this well enough, you have to understand that we can either have a falling price to book ratio or a rising price to book ratio. Progressively, we look at the progressive aspect of it. Even though let's say it was 2 point something the first year, or let's say it was 1 point something, 1.5, the price to book value, let's say it was 1.5, then it went to 1.7, then it came down to 1.3, then it came down to 1.2, then it came down to 1.0. Now this is a falling price to book value ratio. Although there was a pump before from 1.6 to 1.7, it doesn't now ignore the fact that it was sloping down. Okay, so we're looking at the progressive, you get, and we now look at the return on equity, you get. We can also have a rising or falling. So when we consider both aspects, because we're looking at it one like simultaneously, this fourth aspect looks at these two simultaneously. The first aspect I talked about only looked at the price to book value ratio, and then I told you anything between 0 and 1.0 is a good stock, right? So now this aspect looks at the two of them simultaneously. It's okay. And the best combination I found after a lot of analysis and reviews, right, is that any stock that has a falling price to book value ratio and then a rising return on equity is considered a good stock. And anyone that has the opposite, or like not this one, not this combination, right, is considered a bad stock. This is something you have to keep your mind out for when you're investing in stocks, or when you're carrying out your fundamental analysis in stocks. Then let's now look at the third aspect, which is the cash flow criteria. So what this cash flow criteria is basically trying to say is that it's basically looking at the cash flow, right? The book value is looking at the book value. You're basically going to be looking at the statement of financial positions and the income statements. Right? The cash flow is basically you're going to be focusing on the statement of cash flow. I hope you're not getting too confused with these things. These are basically what I call them financial statements you have to look at when you are analyzing. The accountants will get it, the financial analysts will understand. If you're someone who does not have a background in accounting or finance, it's still fine. You can just basically do a research on these terms, like what are financial statements, then you look at the statement of financial position, the income statements, the statement of cash flow, notes to the accounts, and yeah. So Now we've looked at the book value. Now let's now look at the cash flow. The reason why I will pick the cash flow over any other form of criteria is because the cash flow is harder to forge. It's harder to manipulate, right? Because we're talking about cash flow. For the book value is quite easy. I'm talking about the likes of creative accounting. For the book value is quite easy to manipulate, but then the cash flow is pretty hard to manipulate. And the more cash a company generates, right, the more attractive it looks. So this is something you have to keep your eye on when you're looking at the cash flow statement, because you have to look at the amount of cash the company is generating, and then you also have to compare, okay, is the company highly levered or low levered, to get, because a company can either rely on equity or debt, to get, so it's one of the two. So you have to look at that. Even in your working capital analysis, you also have to look at that, because your working capital, you're looking at the interplay of current assets and current liability and which one is stronger, so you don't find yourself in an over trading position, right? So now let's kick in and let's look at the checklist for this one. So basically what you're looking at in this is that, because like I said, you're looking at the cash flow, and like I said, the cash flow basically you have to look at the statement of cash flow. So there are certain things under this that you have to look at that will give you or let's say that will point you in the right direction towards a good stock or a bad stock. One thing you have to look at is the price to cash flow. For the book value, we said the price to book value. For this one, I say the price to cash flow. And a decreasing price to cash flow, like I said, you can always see it on your stock screener, or you can calculate your own if you want to. Price to cash flow record a decreasing price to cash flow over a period of 3 to 5 years is a very good pointer towards um the identification of a good stock or a bad stock, right? A decreasing price to cash flow is an indication that the stock is good. An increasing price to cash flow is an indication that the stock is bad. So if you are doing your analysis and you find out that, okay, this stock is showing a progressive increase in the price to cash flow, then it means that it's a bad stock and the stock should run away from. Right? And basically, how you calculate this is your share price divided by the net cash flow. Right? If you now want to do it based on the cash flow per share, then you basically have to do your net cash flow divided by number of shares outstanding. So that's basically how you do it. Either way, you should be able to get the same either decreasing or increasing um, price to cash flow. Another thing you have to look at is the market cap too. Right? And from what I've been saying since, you should know what I'm about to say when I look at market cap. Of course, I'm going to look at the small market cap or the small cap stocks, because these are very, very important especially if you want to, let's say, hit those stocks that can give you about 20-35% a year. Small cap stocks are the ways to go. They are the way to go. And also you have to look at your low price stocks. Value of stocks very important. We mentioned it in the first one, value like criteria. We mentioned it in the book value, and we're mentioning it here again. If a stock is too expensive, kick it out. It's as simple as that. Get and another thing we have to look at is we have to look at the price to cash flow on its own. The first one we look at a decreasing, which is over the period of 3 to 5 years, just like we did the book value. We compare it to price to book value and return on equity, right? But for this one, we only did the decreasing cash flow, so you should have a decreasing price to cash flow. Get now, we want to look at the price to cash flow in a particular year. So, okay, if you want to analyze based on just 1 year, what do I have to do? So, a low price to cash flow is that indicator that the stock is good. And like I said, you can either do the cash flow singularly, I mean, when I mean singularly, I mean like, okay, you are doing cash flow divided by total shares outstanding, or you can do cash flow on its own. Basically, whatever you get, right, should give you a good pointer towards a low price to cash flow. And the fourth criteria we're looking at today is the dividend. Right, dividend is basically what I say the fourth and final criteria to look at, and it is very, very important. So what are the checklists we have to look at here? So we're looking at the high yield, we're looking at the dividend yield, and then we're looking at the payout ratio. Just like we did in the book value, we're going to be looking at this in tandem. So any stock that has a high yield, very very important, because you cannot be playing with stocks with low yield. No. So looking at high yield and low payouts. And I'm talking about low payouts because a lot of people will have questions to what's a low payout ratio. A low payout ratio is basically anything around less than 40%. Okay, anything less than 40% is okay, let's say less than 42% is a low payout ratio. Anything below that is a low payout ratio. So when you're looking at low payout ratio and high yield, you offer a high yield, anything above 10% is high yield. So once you're looking at that, the combination of these two metrics should help you eliminate some stocks. Yes. Then also the second aspect we're looking at now is dividend stocks or non-paying dividend stocks, those companies that do not pay dividend, right? So for me, from analysis or from basically what I've done or what I've seen in the stock market, it's always favorable to go with stocks that pay dividend over those that don't pay dividend. And that's because you see that those that pay dividends tend to have um good and they tend to have more good potential than the others. And it's weird because you expect that those that don't pay dividend, right, should be able to use that capital to for capital expansion or to plow back into the business, right? But then when we look at the data, you find out that it's not always the case, because those that pay dividend tend to even do better, okay, than some, right? Then another thing to look at when considering dividend, right, is that if let's say you are analyzing now, it is 2023, you're analyzing, and then you see a stock, and then you want to invest in it, you're just checking the news, and then you see something, and then you see um a company that's about to do a stock cut, like the company is about to, let's say, split the stock. Once you see that news, right, this is a very strong indicator that you should wait, you should not buy that stock, right? And a stock cut, why I say this is bad for a stock cut, right? What they're basically trying to do is that they're trying to, let's say, reduce the perceived value of the stock. That's the implication of what the whole stock cut is. And you see that most people, because of market sentiments, they will tend to sell immediately. And once people get to sell immediately, like I said, the market basically operates on demand and supply. So when they begin to sell immediately, there's going to be a huge drop in the market. Get for those who trade, okay, I think this is the perfect time to take like a sell position, if you know what that means. To get, well, those that are looking for long term investing, because your stock value is basically going to be determined by the ups and downs. To get, so if you invest in a stock 10,000 and the value